Hey there, it's Mike Wise, CMG Home Loans, and your weekly mortgage update. So this week, a lot of moving factors, but at the end of the day, a couple of the things in the middle of the week that happened. One is President Trump, he pulled back his talk on firing Fed Chairman Jerome Powell. And so he said, no, I'm not going to fire him, and just relax on that. That calmed the markets down a little bit. The second thing was President Trump, and Treasury Secretary Bessent basically pulling back and kind of having negotiations with China and kind of bringing back those tariffs a little bit. That calmed the market down. That brought down interest rates below the 7% number. But let's take a look at some of the details on what's going on in the market. So these are some of the talking points that we want to go over, right? So should the Fed cut the rates now or later? Well, this is it's a good question, because at the end of the day, the Fed is data dependent, and they are relying on the unemployment number rate. It still looks really good, right? The numbers based on the data look like we're at full employment. Next week, we will see those numbers come out and kind of see where we're at. So right now, the Fed, they're more focused on inflation and what the impact of those tariffs are going to be on the inflation. So that's where their focus is right now. My opinion, they're keeping their eye off the ball. They're going to act too slow on this. But at the end of the day, we're talking about a good recession cures inflation. Why is that? Well, at the end, what happens is this demand destruction is what we call it, right? So the demand destruction, basically people are more concerned about losing their jobs, and the price of everything has risen, inflation, right? So they stop buying stuff to save money. That's going to put us into a recession. So all of that being said, there's a lot of action right now of what is going to happen with these tariffs, what is happening with the job market. Is everybody on board with that? So let's talk about a couple of these things. One is right now, the question is that mortgage rates. What happens to mortgage rates in a recession? Well, during the last 6 recessions, mortgage rates have dropped. And that is going to be the case in this instance as well. If we do go into a recession, you're going to see the interest rates start to drop down, because what they want to do, the Fed, they're going to lower the interest rates. They want you to see those numbers go down. Now, housing values. What happens to the housing values? Well, 4 out of the 6 recessions, the last recessions, the values have gone up, right? And I think 2008 was a little bit of an anomaly based on kind of the mortgage world out there and the loans that we were offering there. But at the end of the day, don't worry about your prices. As interest rates go down, values are actually going to go up. So if you can afford something right now, now is a good time to do that, because we think that the interest rates, they're going to go down. There's going to be more demand for the real estate, and the real estate prices are going to stay pretty strong. So let's see here. What's happening? The Fed, they meet over the next 6 months. These are their meeting dates. There's a 90% chance today that on the May meeting in 2 weeks that you're not going to see a rate cut. So they're going to keep the rates the same. I don't think that they're going to do it in December, but what I do think is that there's going to be at least 2 times here, and probably 3, that you're going to see in June, July, September, October, those 4 months, and probably the middle months there, June, July, and September, you're going to see the Fed cut the interest rates. That means they're going to cut probably 0.25% at a time. So that means that we're going to see basically a 75 basis point improvement in the Fed funds rate, right? And so we're going to go from 4.25% down to 3.5% on the Fed funds rate. That is good news for everybody. That is good news for mortgage rates. Mortgage rates are not directly related to that, but this does help significantly when those things are going on. So the other thing I want to talk about is deregulation. One of the things that the Treasury Secretary is talking about is deregulation with the banks. The deregulation is a big deal because what happens there is he's trying to get the smaller banks to hold more treasuries. If they can hold more treasuries in their bank, that means that they're going to buy treasuries and hold them there, right? And that means that prices are actually going to get better on those treasuries and yields will start to go down. The other thing that Bessent has been talking about is getting the Fed funds rate down to getting the yield on the 10-year Treasury down to 3.90, right? So that's his goal. I think that that's probably I'll show you in just a second why I think that is very, very interesting. But let's talk about interest rates first. So interest rates are 6.92 right now. So interest rates 6.92 as of today. So let's go back to our numbers here. So if interest rates are 6.92 today, the yield is 4.27. The spread there is 265. So the difference between those is 265. I think that the Fed funds rate, they're going to try and get it down to 390. And if you add that 265 number in there, that means that interest rates are going to be 655. So I think in the short term, you're going to start to see interest rates hit 6.55% or 6.5%. And here's why I think that, because this is the yield. Oops, I'm going to go back here and I'm going to show you this again. This is the yield on the 10-year Treasury. Now, you can see all of these numbers. There's a lot of stuff in here. But what I want to show you is on April 1st, this was the floor that we saw. Guess what that number was? 391. So very interesting that Scott Bessent has been talking about a 390 yield on the 10-year Treasury, and it hit the floor there. Now, it's gone up since then, and we're at, the 427 as of this morning. But it's very interesting that the floor, we hit that 390 number, which is right where Scott Bessent has been talking about. So I do think that we're going to see that 390 number come sooner rather than later. And as that comes down, I do think that the spread, because the spread that I talked about just a second ago was 265, I think that spread is going to narrow. That was the difference between mortgage rates, 690 and 427, right? So that was the difference between those numbers. I think that spread is going to narrow. So I think we're going to get to a 390 yield on the 10-year Treasury. And I think that the spread is going to go down to 2.25%. So that means that we're talking about interest rates at 6.15. So I think that we will see interest rates in the next 4 to 5 months around 6 to 6.125%. So that's where I think that the interest rates are going, and that's where we're headed. As of today, like I said, we are at 692 on basically 7% on the jumbo and conforming 30-year fixed rate mortgages. So that's my input for the day for interest rates. Hopefully that was beneficial for you to hear. If you have any questions, please let me know. I will be around this weekend to answer any questions. Have a great weekend, and we'll see you next week.